Hi, Assalamualaikum warahmatullahi wabarakatuh. Today our group will present about dividend policy, which is clientele effect.
First of all, I would like to introduce our group members. First, we have Amir Asyraaf bin Sabri. Second, Ahmad Faris bin Abdullah. Third, Nurin Athirah binti Ahmad Nizam. Fourth, Tuan Syafiqa Syazween binti Tuan Mohamad. And lastly, we have Nur Syauqina binti Mohmad Esa.
Let's start with what is the clientele effect. The clientele effect is the idea that the type of investors attracted to a particular kind of securities will affect the price of security when policies change. It explains how a company's stock price will move according to the demands and goals of investors in reaction to a tax, a dividend or another policy change. It implies that the two sets of factors are likely to cancel each other out after all. High dividend payout may attract investors that need a regular cash income as source of fund to meet the living expenses, investors that low income tax bracket, investors that risk averse investors, low risk taker such as the institutional investors who prefer regular and stable dividend, and investors that rely on fixed income like the retired pensioner, widow and orphan.
Then, I will elaborate more on clientele effect. It leads to increase in demand for the firm's share and positive effect on the firm's value. Some clientele would prefer a company that doesn't pay dividends at all, but instead invest their retained earnings to finance project with positive NPV. It is because investors believe that the good growth potential and positive NPV project will increase earnings and rise in share price and apparently will create healthy capital gains. Furthermore, low dividend payout may attract investors that have high income tax bracket and wealthy and sufficient earnings from their paid employment.
The contents of what is clientele effect. First, the existence of clientele effect implies that certain investors are buying shares because of the dividend policy employed. Firms need to adopt a stable and consistent dividend policy. Secondly, those who prefer dividend gain over capital gain, there are subsets of clientele that might prefer a stock that pays a high dividend, while another subset might look for a balance between dividend payout and reinvestment in the company with low dividend. Finally, any change in the dividend policy would influence the clientele group that might force them to sell the shares that eventually will result in a drop in the share price.
Next, let's move to the advantages and disadvantages of clientele effect. The first one is the company will have good financial report to be presented to the investor. This will be favorable not only to the investor but also to the company. The second one is only need to declare and distribute the dividend quarterly and annually. Therefore, they can focus to maintain their growth or the company to grow their profit so they can give out the dividend. Lastly, they can absolutely refraining from making dramatic changes to such policies to prevent achieving clientele which may negatively impact the company's share price. Next, let's look to the disadvantages of clientele effect. The first one is the company must maintain their reputation in the market and the company's growth to extract the investor out there. The second one is they may face difficulty to enter market if dividends and the result is not favorable. They also need to balance between the company goals and the investor growth, as there are investors who cares about the company growth more than only depends on the dividends. The last one is, do you know that different policies attract different investors? Therefore, it is limited to certain investors to invest in their company.
Now, I will continue with the example. In a world where many investors like high dividends, a firm can boost its share price by increasing its dividend payout ratio. Is it true or false? The statement is likely to be false. As long as there are already enough high dividend firms to satisfy dividend-loving investors, a firm will not be able to boost its share price by paying high dividend. A firm can boost its stock price only if an unsatisfied clientele exists.
For more understanding of the clientele effect, I would like to highlight the article that was published on May 2018 which titled Dividend Policy and its Impact on Firm Valuation. This article is written by Adam and Brand and Tobias Innocent. The objective is to study the relationship on the dividend policy and stock prices on the Swedish market. Based on the relationship, it is to investigate how the company's payout will change in response to the firm's performance and the stock price. According to the study, various factors such as capital structure, possible stakeholder signaling, and corporate culture about payout may influence the company's dividend policy.
Key point of the article, which is one of the artist's goal, is to look into the impact of dividend policy on how stock value react to the business performance It is because the bigger the dividends, the lower the stock's price. Stock prices are connected and influenced by financial results. A company's dividend payout policy is safe and consistent. However, due to unforeseen effect on stock price may give impact on the dividend policy. Secondly, stock price with lower dividend yields should be more dependent. And finally, a wise investment selection should be made.
That's all from our presentation. Thanks for watching and Assalamualaikum.